Most people think legendary traders succeed because they know hundreds of patterns, secret indicators, or some kind of holy grail that nobody else has access to. If that's what you believe, let me congratulate you, because you're absolutely wrong. The truth is the exact opposite. Think about it. Every day, millions of traders open their charts, scroll through dozens of indicators, and jump between countless trading strategies. One day they're trading breakouts, the next day they're chasing moving averages, and by the weekend they're studying Elliott waves. They believe that the more they know, the safer they are. But in reality, they're drowning in complexity. And complexity is the enemy of execution. The most successful traders in history don't complicate things. They don't waste time trying to master every single method under the sun. Instead, they go deep, not wide. They focus on simplicity, depth, and mastery of just a few methods that consistently work. Bruce Lee once said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." In trading, it's the exact same principle. The trader who dabbles in 50 patterns never masters any of them. But the trader who studies one setup, executes it relentlessly, and understands the psychology behind it, that's the trader who wins.
Look at history. The legendary Nicholas Darvas mastered his box theory. Richard Dennis trained the turtle traders to follow a single trend-following system. Jesse Livermore lived by the law of supply and demand. And Mark Minervini, one of the greatest traders alive today, built his fortune not by knowing everything, but by going all in on one pattern he calls the volatility contraction pattern, or VCP. This is how Minervini transformed a relatively small account into a fortune that would eventually exceed $72 million. Not through magic, not through having access to secrets that no one else knew, but by simplifying, mastering, and executing a single high-probability setup again and again. And that's exactly what we're going to dive into today. In this video, you'll learn two things. First, how Mark Minervini mastered the VCP to become a trading legend. And second, how you can apply this same pattern to stocks in today's market.
Part 1. How Mark Minervini made $72 million with VCP. Mark Minervini is not just another trader with a flashy track record. He is one of the very few people who have proven, on paper and in public, that extraordinary results are possible when skill, discipline, and method come together. He's a two-time U.S. Investing Championship winner, an achievement that instantly sets him apart from the crowd. In 1997, Minervini shocked the trading world when he posted a staggering 155% return in just 5 months, securing first place in the championship. More than 2 decades later, he came back to prove it wasn't luck. In 2021, he entered again and delivered another 334% return, taking the title a second time and reminding everyone that his edge had not faded with time. Over his career, he has compounded those kinds of results into a fortune of more than $72 million, turning what started as a small account into life-changing wealth.
But championships in numbers, as impressive as they are, only tell part of the story. What truly defines Minervini is the philosophy behind his trading. He is the author of 2 widely respected books, Trade Like a Stock Market Wizard and Think and Trade Like a Champion. Both works capture his belief that trading success does not come from knowing 1,000 different strategies. It comes from mastering a repeatable process and applying it with relentless consistency. For him, that process revolves around one setup, the volatility contraction pattern, or VCP. The idea behind VCP is deceptively simple. Imagine a stock that has already made a strong run higher. At some point, it pauses, and instead of continuing to surge, it begins to move sideways, consolidating its gains. During this consolidation, it doesn't just drift randomly, it contracts.
The first pullback might be sharp, perhaps a drop of 25 to 30% from peak to trough. The next time the stock pulls back, the decline is smaller, maybe 15%. Then another contraction of only 8%. And eventually, the stock is barely dipping 4 or 5% before buyers show up again. With each contraction, the swings in price get tighter, and the trading volume often shrinks. What this signals is powerful. Sellers are running out of ammunition. Each rally attempt meets with less resistance, and each pullback becomes shallower.
From a psychological perspective, this makes perfect sense. The earliest sellers have already taken profits and moved on. The weak hands have been shaken out. Meanwhile, buyers who believe in the company are watching closely, waiting for the right moment to commit. As volatility contracts and volume dries up, the balance of power shifts. By the time the stock pushes against the upper boundary of its consolidation zone, supply has been largely absorbed. When a breakout finally happens, accompanied by a surge in trading volume, it often leads to an explosive move higher. Demand overwhelms supply, and the stock enters a new phase of strength. This is why VCP became the cornerstone of Minervini's trading. It offered him something that few setups can consistently deliver: a high-probability entry with clearly defined risk. The pattern naturally provides a logical stop-loss point, just below the most recent contraction, so risk can be tightly managed. At the same time, it positions the trader to capture the next major leg up in a leading stock. In Minervini's hands, the VCP wasn't just a chart pattern, it was a disciplined framework that aligned perfectly with his philosophy of protecting capital first and letting winners run.
Over the years, this single pattern became his one kick practiced 10,000 times. It gave him the confidence to trade aggressively when the odds were in his favor and the discipline to step aside when they weren't. It was the method he relied on to post triple-digit returns in public competitions, and the same method he used privately to compound his wealth. And here's where the story connects directly to us. The volatility contraction pattern is not a relic of Minervini's past, nor is it a trick that only works under special conditions. It's a principle rooted in supply and demand, in human psychology, in the way markets have always functioned, which means it can be applied today, right now, in the stocks we watch every single day. Part 2. Applying VCP to today's market. After understanding how Mark Minervini mastered the volatility contraction pattern, the natural question is, how can we actually apply this setup in today's market? Let's take a look at one of the most powerful examples in recent years, NVIDIA. In 2023, NVIDIA had a massive run-up of about 250%. This first leg higher is absolutely critical. In Minervini's playbook, a strong prior uptrend is the prerequisite for a valid VCP. Why? Because it tells us the stock has already transitioned from a weak, downtrending structure into a position of strength. It signals institutional demand. Without that initial move, any consolidation that follows may not carry the same weight. But here's where things get interesting. After a stock doubles or triples, it's natural for investors to take profits. When early buyers lock in gains, supply comes back into the market. Now, one of two things can happen. If the growth story is over, the stock will crumble under the weight of that selling and the rally will fade away. But if the story still has legs, if institutions continue to believe in its future, then instead of collapsing, the stock will pause, absorb the selling pressure, and begin to contract into tighter and tighter ranges.
That's exactly what happened with NVIDIA. After its explosive rally, it didn't crash, it consolidated. The first contraction was about 17%, sharp but healthy for a stock that had just soared 250%. The second pullback narrowed to 15%. Then the third came in at 10%. And by the fourth contraction, the stock was barely dipping 5%. Each pullback was shallower than the last. The price swings were shrinking, The volatility was contracting, and the volume during those dips was drying up. In Minervini's terms, the stock was building a textbook VCP base. Psychologically, this is powerful evidence of conviction. Sellers were getting weaker. They had fewer shares left to unload, or they were unwilling to sell at lower prices. Buyers, on the other hand, were quietly stepping in every time the stock dipped. This tug of war between supply and demand tilted in favor of the bulls, but it wasn't obvious until the last contraction. That's when the stock reached a critical pivot point.
The way traders act on this is simple in theory, but it requires discipline. You draw a resistance line across the highs of each contraction, connecting the peaks of the tightening range. Then you wait. You don't jump early, you don't guess. You wait for the breakout. The moment the stock clears that line with conviction, confirmed by a surge in trading volume, that's your green light. That's when the probabilities align. For NVIDIA, that breakout triggered a massive continuation. From that pivot, the stock went on to gain another 180% in just over 5 months. That wasn't luck. It was the natural result of institutional demand overwhelming exhausted supply, exactly the behavior the VCP is designed to capture. And this is the beauty of Minervini's approach. You're not chasing stocks randomly, and you're not relying on hope. You're watching the natural rhythm of supply and demand play out on the chart, and you're stepping in only when the evidence shows that the balance has shifted decisively.
At the end of the day, what made Mark Minervini extraordinary wasn't that he mastered hundreds of strategies or memorized every chart pattern ever written about. Quite the opposite. His greatness came from narrowing his focus down to one powerful setup, the volatility contraction pattern, and dedicating himself to understanding it so deeply that he could see it forming almost instinctively. That's a lesson worth pausing on. In trading, complexity is seductive. It feels safe to collect more indicators, more theories, more what-ifs. But the truth is, the market rewards simplicity and execution far more than endless information. Minervini didn't scatter his attention across a dozen half-baked methods. He built mastery around a single, repeatable edge. That edge became his compass, his filter, and ultimately his fortune, more than $72 million. And that leads us back to you. If you take just one thing from today's video, let it be this. You don't need to know everything to win in the stock market. You just need one method, studied deeply, tested relentlessly, and applied with discipline to tilt your odds in your favor. That's what Minervini did, and it changed his life.
So here's my challenge for you. What's the one pattern you're going to master? Will it be the VCP, with its story of tightening ranges and explosive breakouts? Or maybe another setup that speaks to you? Whatever it is, commit to it, because focus builds mastery, and mastery builds results. If you found this breakdown valuable, hit like, subscribe, and drop a comment below sharing which chart pattern you're focusing on right now. And if you'd like to support the channel, consider joining as a member or using the Super Thanks button. It helps me keep creating deep dive content like this for you. Remember, trading isn't about being everywhere at once. It's about finding your edge and mastering it. That's how Mark Minervini did it, and it's how you can start building your own path to success.